Finding ETFs that pay a healthy dividend is one of the great ways to find investments for our portfolios. A common misconception that can hurt new stockholders is a high dividend yield. Now don't get me wrong, high dividends can be a chance to buy a stock or a group of stocks that may be currently undervalued by the market in times of economic uncertainty, but not when the investment vehicle uses derivatives to generate these dividends. Today, we look at the pros and cons of the Global X Nasdaq 100 Covered Call ETF, ticker symbol QYLD. QYLD currently pays a 12.76% dividend yield. That seems pretty impressive. Here are some reasons that Global X gives you to invest in their fund. Number 1. High income. Number 2. Monthly distributions. Number 3. Efficient options executions. But the QYLD Global X Nasdaq 100 Covered Call ETF has horrible performance when compared to the Nasdaq 100. So let's start off with the bad news first and cover why QYLD isn't all that it's cracked up to be with the cons. Con number 1. It lies about its strategic goal. Well, kind of. Global X Nasdaq 100 Covered Call ETF doesn't really track the true performance of a covered call strategy. I personally backtested the simple yet expensive strategy on the QQQ, which is a Nasdaq ETF, exactly as the investment prospectus said. And in 2022, with the income from the covered calls, the strategy obtained a negative 2.65% return, while the QYLD had a total return of negative 15%. Normally, tracking errors shouldn't be this bad. And the reason for this is because QYLD doesn't actually track the strategy. It tracks an index that deploys this complex mathematical strategy. And unfortunately, this index, the CBOE Nasdaq 100 Buy Right version 2 index, performance is terrible. Con number 2. It doesn't distribute all the income. Again, lying. For whatever reason, even though it has been distributing income for over 7 years, it only distributes up to 1% per month of the ETF's NAV or net asset value. Some months the fund collects over 4% and only distributes 1%. Here, in their How It Works presentation, they illustrate a 2% assumed premium collection as how it is expected to perform. However, in their covered call report footnote, they note, as a general guidance, the monthly distribution of QYLD is capped at the lower of half of premiums received or 1% of net asset value. The excess amount of option premiums received, if applicable, is reinvested into the fund. Year-end distributions can exceed the general guidelines due to capital gains that are paid out at the end of the year. If this was the case and these option premiums that we received were reinvested into the fund, there should have been over 20% in excess reinvestments into the fund. But at the end of the year, there was no excess distributions of capital gains. Where did it all go? The third con. The fund is always 100% covered. The options moneyness is at the money. 100% covered means that our upside is completely capped. Even though in our number 2 con, the excess call premium collected should go toward purchasing more assets, we never see NAV increase or increase in premium collected when these new assets are added or call premium is written for. Therefore, our fund can never increase in value once premiums are written. And the fund being 100% fully covered means we cannot experience any capital appreciation. Con number 4, and our last one, it's expensive. 60 basis points would be understandable for a complex strategy using derivatives. But this is a simple strategy that uses derivatives, unlike JEPI or DIVO, which uses asset allocation and investment strategies underneath the call option overlay. QYLD simply follows an underlying index, the NASDAQ 100, and writes a call every month, checks on that call once a month, writes another call, then repeats that once a month. I literally did all of that work for an entire year in 1 hour backtesting this strategy for 2022, which I did an entire video on, which you can see here linked in the description down below. To add insult to injury, both JEPI and DIVO charge less than the QYLD for their expense ratio. That was a lot of cons, but QYLD isn't all that bad. Now we're going to move on to the pros, but before that, to keep updated, be sure to subscribe and hit the notification bell so you can be amongst the first to know when more investment inspiration videos are available. Also, if you like these types of videos where I do a deeper dive into ETFs, be sure to let us know in the comment section down below so we can make more videos like this. Now, on to the pros. Yes, there are some. Regardless of how you think I feel on how bad this fund is, I think it may just be misrepresented. Pro number 1. QYLD is a great bond alternative. As mentioned earlier, QYLD pays a 12.76% dividend yield. If you had bought QYLD in the beginning of 2022, you would have received a 9.83% yield to cost. Similarly, if you had invested in the bond fund TLT, the 20-year Treasury Bond Fund ETF, you'd only have a 1.81% yield to cost, and you'd have been down 28%. The most eye-opening fact I found here is that the total return from its inception till February 7th of QYLD is 6.39% compared to TLT, whose total return over the same period is just 2.57%. So if you would compare it to a bond fund, the QYLD, as an income generating ETF, it now looks a lot better. Pro number 2. Because of QYLD's option selling nature, the fund typically provides more reliable income in times when the market is volatile. Therefore, those that need income in down markets have the ability to collect income without selling their distressed assets, something I'm sure seasoned investors can appreciate. Pro number 3. The ability to take advantage of complex tools like options and derivatives without opening a margin account or learning about these complex derivatives. Many times, in order to use options within your account, your broker-dealer will require you to sign extra paperwork and attest to understanding more complex financial products, and also require you to have a more speculative financial objective. Even though options, in my humble opinion, can be used to minimize and control risk, you must understand and attest to understanding on how to do that. And many times people are a little bit apprehensive on doing just that. And this fund allows you to do that without going through all of that hassle. The fourth and final pro, the fund has $6 billion in assets. That means that there are a lot of investors who want exposure to this type of strategy. Not to say that perhaps Global X just has an awesome marketing department. Having $6 billion in a relatively expensive ETF from a seemingly new age company in the era of Vanguard's low fee funds and Fidelity's no fee funds is no small feat. To see the top list of dividend paying ETFs, click here for our highest yielding dividend paying ETF list for 2023.